You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Well, today we just got the news. If you're looking at the calendar, it's the 12th of Tuesday. Inflation is just spiraling out of control. What does that mean for you, the investor? And what does that mean for the economy and life in general? Well, here is our good friend, Jim Welsh. And Jim, it's great to have you back on the phone. And what has Macro Tides got to say about this inflation situation?
Well, for much of the last year, Kerry, my take was that inflation wasn't going to be transitory, and that the Jay Powell and company were wrong about that. And obviously, that's the way things have played out. This morning, some people were heartened because the core inflation was like 0.1% less than what they had expected, which is kind of ridiculous because it was still up 6.5%, and the overall inflation up 8.5%. So, over the next handful of months, what a lot of listeners may not be fully aware of is the CPI is just a 12-month rate of change. So they take away a number from 12 months ago and they add the current month in, and that voila, that's what you have. April, May, and June of last year, the CPI jumped a lot. So the takeaway values over the next 3 months are pretty high. And there's a good chance that the current readings that come out in the next 3 months will be very slightly lower than those takeaway values. So, what I've been writing about is we are likely to see inflation peak in March because of the mathematics of the equation. At the same time, the dynamics that have been driving inflation aren't going to materially improve. So the improvement in terms of how much the CPI might drop over the next 3-4 months might be, from 8.5 down to 7.8, 7.9. That's really not much of an improvement. So I just think investors are just myopic in terms of believing that this is just going to go away, and that somehow a slight drop in used car prices means the Fed doesn't have to be as aggressive raising rates. I mean, that's just ridiculous. But that's, what a lot of people have been thinking.
Yeah, obviously you're not.
No. I mean, I think the reality is with inflation at 40-year highs and really at enormous numbers, wages are growing, but inflation is growing faster than wages. So for most people, their purchasing power is actually declining, even though they're 5%. And so I think the Fed, as I wrote in my last letter for April, was, the Fed's got religion. And they realize they need to act forcefully. And, I think a lot of investors over the years have developed this idea that there's a put, the Fed put for the for the market. And really what the Fed looks at are financial conditions. And part of financial conditions are things like a stronger dollar, higher bond yields, spreads between treasuries, bonds, and corporate bonds. But the other element is the stock market. So when the market rallied from mid-March into the first few days of April, that actually brought and loosened financial conditions, which is the exact opposite than what the Fed wants. As Powell said really clearly a couple of weeks ago, they're going to gear monetary policy, Kerry, to bring demand down. Since they can't increase supply of computer chips and labor, force participation and workers and so forth, they can try to mute demand. And so they're going to move policy so that financial conditions tighten. And to me, that's just Fed speak for we're going to see bond yields go up and we're going to see the stock market go down. And Bill Dudley, who was the president of the New York Fed late last week, basically said the Fed is going to push the stock market down because that's what they need to do to get financial conditions to tighten. And I think a lot of people just think that, if the market goes down by much, the Fed's going to come to the rescue. And I like to remind folks, in between 2001 and 2003, the S&P was down 50%. The Fed cut rates continuously. It didn't matter. 2007 to 2009, the S&P was down 57%. The Fed cut rates continuously. It didn't matter. So the reality is the Fed isn't all powerful in terms of if conditions are such. And I think we're in that kind of environment where the economy is going to slow. The Fed wants to curb demand, and a slowdown in the economy while the Fed maintains pretty tough talk about inflation and raising rates and shrinking their balance sheet. I think that's a real bad combination, excuse me, for the market. So my expectation is that the S&P will drop below 4115, which was the low in February. And I think there's a potential of a decline to 3850, which happens to be the 38.2% retracement of the rally from March of 2020.
Yeah, tough days ahead for the not too distant future, huh?
Yeah. I mean, the Fed isn't going to back off. And I think, unfortunately for the Fed, they picked exactly the wrong time to do average inflation targeting. August of 2020, they said, you know what, up to now, once the labor market tightened, we would start to raise rates gradually in anticipation that a tighter labor market would lead to inflation. And so that meant you'd have very gradual rate increases as the economy was doing well, which is why, and you'll see a lot of people talking about this, Kerry, that, oh yeah, the first year after the first rate hike, the S&P goes up on average 10%. Yeah, that was because they were operating under a different framework for monetary policy. Since August of 2020, the Fed said, okay, we're going to wait until we see the whites of the inflation eyes. And then they waited to not only see the eyes, but the whole monster. And so they're way behind the curve. So rather than it being a gradual increase in rates, they have to do an accelerated pace. Ned Davis did some analysis, and yes, gradual rate hikes, the S&P goes up 10% after the first rate hikes. However, in the cycles where the Fed had to be more accelerated in rate increases, the S&P was down over the following 12 months. Not by a lot, but again, that's very counter where the perceptions and what people are reading is, hey, we don't need to worry about rate increases because the S&P goes up 10% in the first 12 months. We're in a completely different ballgame.
Well, different ballgame. And so what do? How do you protect your wealth?
Well, in December, my expectation was that in the first quarter, the S&P would drop by 10 to 15%. Obviously, that unfolded. We had a really strong snapback rally into the, March. The S&P got a little bit above 4,600. I think it was 4,637. I advised people when the S&P a couple of weeks ago, to lighten up because I felt that the odds were shifting for another decline. And then back in January, I said if the S&P drops below 4,200 and 4,150 to add exposure, and there was a big down day on February 24th, and that's the day of the low at 4115. So to me, you got to bob and weave in this kind of environment. So to me, it made sense to add exposure when the S&P was trading under 4150, and it made sense to lighten exposure when we're up near 4600. And I think that still goes. I think we're in an environment, if the S&P bounces back up toward 4,500, 4,550-ish in the next handful of days into next week, Kerry, I think that's an opportunity to lighten up because I believe the probabilities of a decline below 4115 is going to come. The other thing, I've recommended gold back when it was around 1,800 in anticipation that it was going to rally to 1920. And then as we got there, I was like, okay, I think we're going higher. And over the last handful of weeks, gold got up to 2,068, I think it was, pulled back sharply. But from a chart standpoint and just the fundamental stuff that you and I are talking about in terms of inflation, I think gold is going to push above 2,070 over the next handful of weeks. I would lighten up if that, in fact, occurs. And in terms of the gold stocks, my expectation was that we would test 40. We've gotten there. And now, to me, it looks like GDX, which is the ETF for the gold stocks, can make it to 4360 to 45. The high in August of 2020 was 45.71, I think. So I think the gold stocks are going to have a push. My concern about the gold stocks, Kerry, is that if I'm right and the market does drop below 41.15, gold stocks, unfortunately, sometimes kind of get caught up in the draft, the selling draft of stocks in general. And I think there's the potential that the gold stocks can have a spike in the short term higher, and then get caught up and have a pretty decent sell off if the market in fact follows suit to the downside.
Really? So the market takes a hit. Do you go back in? Because how long can the Fed really do what they're claiming that they can do?
Don't just survive, thrive. The Financial Survival Network.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Well, they're going to do it. I mean, I think that's the thing. People, and again, I get it. I mean, the Fed remained way accommodative yet last year when it was stupid to do so. I mean, that was a huge policy blunder. And I think people have just gotten conditioned. But my point is, over the last decade, inflation has been running under 2% for almost all of the last decade. So the Fed could be more accommodative because they could get away with it. Well, they can't get away with it at this point in time. They need to act more forcibly. So I think they're going to be raising rates 50 basis points at the May 4th meeting. In all likelihood, another 50 basis points at the mid-June meeting. And I think we're going to continue to see a series of rate hikes. The shrinkage of the balance sheet, it will be about $1 trillion over the next 12 months. And the Fed, Lael Brainard, who's vice chair of the Fed, gave a speech last week and pretty much, hey, at the May meeting, this is what we're going to do. The minutes of the meeting from a month or, in March 16th came out, and they kind of said up to $95 billion a month. So if you pencil it out over the 12 months, you're close to $1 trillion. And in 2018, Kerry, when the Fed shrunk its balance sheet, the S&P struggled. The average stock struggled even more. And ultimately, by the fourth quarter of December of 2018, the S&P was down 20% before the Fed. But my point that I made in my April letter was, if you looked at the financial conditions index, it was at it's kind of perverse in the sense that conditions get tighter when you go above zero. Okay, so it was at a plus 140. And when, the Fed was extraordinarily accommodative last year, it was at like a minus 160. Well, we're back to about zero, give or take a little bit. So my point being is financial conditions have to tighten quite a bit more. And it's only if we get back to where, conditions were back in December of 2018 that I would expect that the Fed would even consider the pause button. There's a lot of other, obviously, factors that will come into that equation. So I don't think the Fed has any choice but to follow through over the next 3 to 5 months, because the inflation data is not going to give them that much relief. As I said before, you might see headline inflation come down, 0.5 to 0.8%. It's still going to be at 7.5 to 7.8%. So that's the box. And I just think the Fed over the next handful of months has got no choice but to continue on that course. They believe, forward guidance is key. And one of the things they want to be doing is talking tough on inflation. They have to follow through with some action, which they will do, to guide and contain inflation expectations. Because in their mind, if inflation settles in, people are going to want more wage increases. they're going to start to buy ahead of time in anticipation of higher prices down the road. And I think we're already seeing that at the grocery store because food prices are really moving up, and they're going to continue to move up in coming months. So you buy a little bit more than what you otherwise would, as long as it's not going to spoil, because you're anticipating, a month from now, that jar of peanut butter and jelly is going to cost you more, So that's why I think the Fed is going to continue with strong rhetoric, have to follow through, because they need to rebuild their credibility, which was damaged significantly, last year when they failed to act. But again, it all comes down to the framework. Prior to August of 2018, the framework that they were operating is, hey, labor market gets tight, start to increase rates. Well, they abandoned that in August of 2018. So the framework is what kind of contributed, along with obviously the Russian invasion of Ukraine and so forth. But I don't see the Fed is going to be backing off anytime soon. Really? And I think the market is going to have to, kind of reconcile with that. And that's another reason why I think the odds are we're going to see some more weakness. Well, the other thing that I recommended was uranium, because Germany made a huge mistake in terms of their monetary policy over the last 10 years. They shut 14 of their 17 nuclear power plants. They're planning to shut the other 3 this year, which is, to me, incomprehensible.
Pathetic.
And they increased their dependence on natural gas from Russia. I mean, it was just stupid, okay? And that made them vulnerable. Around the world, people are looking at uranium and nuclear power because the wind didn't blow as expected in Great Britain last year or in Germany. And so the unreliability, of things like solar and wind energy has driven people like, okay, what can we choose other than a fossil fuel? Well, nuclear power. And I think, my thought has been is that slowly but surely we will see more nuclear power plants built because it generates the cleanest energy of anything. And when you compare it to the amount of land required to build gigantic solar panel locations, it can be like 4 times the land. Huge increase. The cost to build and the materials used to build solar panels is about 17 times the cost of building a nuclear power plant, the materials going into the nuclear power plant. So anyway, I think uranium has the potential to, I talked about it between 23, 26, like this is it. I think it's going to 31 and change. And if it can trade above 31, then it's just going to run for a while. So at a minimum, my expectation is that uranium, URA is that ETF, will make a move towards 31.
Really? Huh. So I guess the question is, you play it in commodities then, right?
Well, I chose the ETF as the vehicle because those companies are involved with mining and so forth of uranium. And obviously, if there's going to be greater demand for uranium, the companies that are involved with mining uranium are going to obviously benefit. And, that's how it's played out. The other thing I will mention is I've been looking for the dollar to spike above 100. And it finally did that today. In the last. Yeah, it poked above it last Thursday, Friday, then dropped below, back above it. I think the dollar is nearing, kind of an important high. I'm not. Let me put it in framework. I think the dollar could pull back to 95, 96. So I'm not in the camp of, oh my God, the dollar's going to lose its reserve status. That may happen, but it probably is more like 4 or 5 years from now, not the next 4 or 5 months. I think the dollar can pull back from 100 to 95, 96, which could also be helpful for gold in coming months, but it would also be beneficial for emerging market currencies and emerging markets. So the 2 country ETFs that I've recommended were Malaysia, which is EWM, and South Korea, EWY. I think both those countries could benefit from a weaker dollar. And then the other thing that needs to come into play, especially for South Korea, is the COVID cases in China, have to peak and come back because COVID has also been ramping up in South Korea. So if we see Asia, and COVID in Asia start to back off, I think that'll be, definitely a plus for South Korea. So those are the sectors I like. And, I would use a stop of about 3 to 4%. Just in case if things get really ugly. The S&P doesn't stop at 3850. It wants to keep going south. Then all of a sudden we're going to see, the damage and selling pressure, move around the world. But that's basically, my game plan in terms of, okay, what do you do in this kind of environment to preserve capital? And, so far it's been working out relatively well.
All right. Well, interesting times ahead, that's for sure. And
you got that right.
I know people are going to want to subscribe to your newsletter. You've been pretty spot on recently. Gold, though, maybe take a breather. It looks like it's kind of trading in a range right now. Obviously, it's up today, $18 on the inflation news. Silver is up nearly $0.50 to $25.50. Is the opportunity in gold gone, or we just take a breather?
I think gold is going to rally above 2070. And, that would probably mean getting above 2100. Basically, the pattern to me, Kerry, is that spike high at 2066 or 67 a few weeks ago was wave 3 of, an advancing wave. The pullback was wave 4. And I think that's why my expectation has been that as long as gold held 1880, now it needs to hold 1910. I think it's going to move above that high for wave 5. And it probably should carry it a little bit above 2100. But I think that's going to be, kind of an intermediate high that you'll see gold then subsequently work its way back and pull back. So I'm looking at it from a trading opportunity to, as I said, I went long around 1800. It gets near 2100. It's like, thank you very much. Let's wait to see what comes next. We are going to see inflation temper a little bit in the next few months. So that may take some of the wind out of gold sales.
All right. Well, we never know what's going to happen till after it happens, I guess, right?
That's why I use technical analysis, because to me, the benefit of technical analysis, for me at least, Kerry, is it lets me know when I'm wrong. I think this is going to happen, but if it drops below this price, then I'm wrong. And that helps a lot from a risk management standpoint. So, it's always a coin. Hopefully we're making educated guesses, but at the same time have the humility to accept the fact that these are guesses.
Guesses it is. Well, hey, your guess is as good as mine. Probably it's better. But hey, if you want to find out more, just tell us how we subscribe. macrotides.com. And you get a lot of information at the website. And if you would like to receive last month's, or I should say the April edition of Macro Tides, send me an email, Jim Welsh, WELSH, macro @gmail.com. And because you're a good listener of Kerry's broadcast, I'll be happy to send you the April issue of Macro Tides. All right. We really appreciate that. And hey, happy investing. Got a question for Jim? You can always shoot me an email to kl@kerrylutz.com. We'll get you an answer. Don't forget, subscribe to our newsletter, financialsurvivalnetwork.com. Jim, always a pleasure. And we'll touch base with you again soon.
Thanks very much, Kerry. Stay well.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.